let's go ahead and kick this off. I'm going to go ahead and start, and then we're going to be really handing this off like a carousel to the different coaches, and we're all going to sort of move through this fairly quickly. So we don't want to take a lot of your time today, and we also want to have a chance to demonstrate the Premier Trader University trading systems and some of the markets from today and recently. So I got a lot of ground to cover. So with that, let's go ahead and kick this off. You can also ask questions anytime, just so you know. Put those into the question box. If a particular coach is talking and you want to ask them a specific question, it's probably best to do it at that time. And O'Brien's going to be monitoring those questions, so you can go ahead and or he'll maybe interrupt, or at the very end ask a question or two of the coaches in case something comes up that you're more curious about. Normal disclaimer: we're going to be showing some charts, some markets, making predictions. You guys know we can't guarantee anything. This is to the best of our ability, obviously. And certainly, any movement or any trading on any of this comes with the usual risk. So just want to put that out there. I think all of you know this at this point. I've already talked about what we're going to cover today: the predictions, the PTU systems, and then how you can learn about and possibly even enroll in the Premier Trader University, which has a class coming up here next week. So perfect timing for that. So I'm not going to cover a lot of this. Most of you already know we've been around since '96. We've got traders in 105 different countries now, and this is some of the yearbook pictures. I don't know if I've got everybody who is speaking today. If I missed one of your pictures, I apologize, but I think we have most. Probably will. Oh, no, I have you on there. Okay, so I don't know. We probably have just about everybody here. I'm sure I forgot somebody on the yearbook photos, but you'll be hearing from really most of the team in the presentation today. If you've missed any of the educational series, we just did one this weekend on scaling your business. We did one last week on a roadmap to Forex trading success. We did one on how to create a full-time income in the futures. You can just go to YouTube and you can search for NetPicks 1 or just search for the NetPicks channel. They're all available there for replay. There have been some really nice webinars that you can go ahead and attend on various topics. So my crystal ball in 2012, what I predicted was the Dow will end 2012 at 13,105. It actually came in at 13,104, so I slightly missed it by a point. I predicted that Obama was going to win re-election and pull down 303 electoral college votes, which he actually had exactly 303 votes.
Wait a minute here.
So I nailed that one.
What? Something's going on here. This is rigged.
No, this isn't. No. This is all true. This is all true. Apple to release a new tablet and call it the iPad. I nailed that one as well. The New York Mets and the New York Jets, two of my favorite teams in quotes, will stink in 2012. Mission accomplished. The NASDAQ 100 will reach 2661. I missed it again. Sorry, guys. Off by a point. It actually ended at 2660. And the Euro US dollar, same thing. I keep missing by a tick. It was going to end at 1.3190, and of course it ended at 89. So I was close, but not exactly on that one. And then, of course, Mark to curve fit and optimize his 2012 predictions to show 100% accuracy, which I've just done. So my point being, you can't actually trade off predictions and forecasts. Most of this is revisionist history and completely curve fit. If you ever watch CNBC, read the Wall Street Journal, anything, that's all it is all year. It's curve fit and changed as things evolve. It's nothing you can actually really trade off of. So most talking heads, most experts, most pundits, it's all fun and games in a way, but it's really never how we're going to actually drive our trading. So the reality is I wasn't quite this accurate. I did say some of the things in last year's webinar. I felt swing trading and active trading going to continue its growth. People are going to be hating position trading more and more. I think that obviously held up. No big surprise, really. Forex trading continuing to grow outside the U.S., not inside the U.S., and it was a terrible year for Forex brokers inside the U.S. There were 18 brokers that were accepting accounts over a year ago. There's now down to 11. 7 pretty big names dropped out of the U.S. business or closed their operations. It's been awful as far as what the regulators changed in Forex inside the U.S. However, outside the U.S., really a completely different trend. Top Forex brokers, success rate sets new highs by the end of 2012. Hit and miss. I'm going to show you in a moment kind of where the different brokers inside the U.S. are seeing the accounts. It'll give you an idea of who's making money and who's not making money, and it's kind of interesting. I felt that a lot more of the successful Forex traders were going to migrate towards the Euro futures and the pound futures, and that may have happened. There's no way for us to really know, What did not happen, what I definitely missed, was I thought the volume would be higher in both of those because it's regulated, it's more predictable, it's more definitely higher trust. Really didn't happen. The volume actually went down the volume went down in Forex, and the volume also went down in Euro futures and British pound futures. I thought crude oil was going to hit 150 bucks sometime in the year. It did go up, but it only hit 122, so I definitely missed that one as well. I did get this one. The U.S. stock market would grow by 10% or more. It was actually up 12%, so at least I did score on that one, even though I definitely missed on crude oil. The slide I wanted to show you on Forex profitability in the U.S., you can kind of see Forex brokers and interactive brokers are the most profitable, and at some broker called ILQ, which I have no idea who that is, are losing the most money, 23%. And then you can kind of see the range here, Oanda, Popular Broker, FXCM, MB Trading. It is interesting that at certain brokers, people are much more profitable. I don't know if that tells you a lot about the broker, the marketing that they do, the style of the accounts, the training they have, not really sure. But it kind of gives you an idea overall. I think if you add this all up, it's probably very flat as far as success in accounts. But one thing is obvious is the growth in accounts is way down. So a lot of you felt you're going to be in Forex at the end of the year. If you're inside the U.S., that's really actually against the trend of where traders are at. So something to think about. I think it's interesting. Now, I don't have these kind of numbers for international, which, like I said, could very much be a different story overall. So my fearful predictions for 2013, the era of the cheap Forex robot has basically run its course, in my opinion. I think that's probably also why we're seeing the number of Forex brokers going down. The easy way of trading that everybody sort of tried for a few years didn't work, and so I think that's a big part of why the accounts are going down. That's why I hope that the percentage of success at the brokers will go up. I still think the market will be bullish and go up 10% or more. China is going to be the best overall growth of all the major countries around the world. Their growth seems to be back. For that reason, I think oil is going to go higher. I won't say 150 this time. I'm going to say 140 or higher. I'm going to say the $1 trillion coin does enter circulation. So those of you who are familiar with all the debt limits, one of those coins is going to be minted. Forex traders, now 70% swing trading. We took the little survey here today. About 54% said swing trading over day. I think that's going to go higher by the end of the year. I still think energy futures, by far the best choice to trade in 2013, better than trading the S&P, the Russell, etc. I think more money can be made in crude, natural gas, heating oil, and unleaded gas. And if I'm wrong about all this, I'm still going to continue to follow my PTU trades each and every day. It doesn't really matter if my predictions come true or not, because I really don't have super high faith in my ability to predict much beyond yesterday's weather. But that's what I'm looking at overall. Will, I'm going to go ahead and hand it off to you, and we'll see if you had perfect predictions or you've got some great ones coming up on the year. So Will, take it away.
Thank you, Mark. And there we go. I think I'm projecting now.
Yep.
So let me go through it pretty quickly. I only have a few minutes. My outlook for the next year, and I did use the best tools available to me to come up with my forecast. But before we do that, this is what I said last year. This was from my slide last year. On the Russell, I pointed out that the rally was weakening. Strong resistance at 900. I did not think we could push through it. And I actually expected a drop down to the 600 level back last year. Crude oil, similar story, consolidating, and it looked like a breakout was imminent. I just had no clue in which direction. So what ended up happening on the Russell, we did indeed come to an end of that big rally since 2009. We only reached a new high, and it was just a marginal new high at the end of September. The 900 level still has not been breached, but my big bold prediction that we would drop to 600, that fortunately did not happen. On crude oil, I really did, a strong breakout in one or two directions. That didn't happen. We're consolidating, and the range is even tightening from what we saw. So, my big predictions didn't work out, and that's why I'm a day trader and not a position trader. So this was the chart I showed last year where I was just looking at the volume. The highs were happening on lower volumes, the lows were happening on higher volume. I really expected a big drop, and 900 is right above there, and you'll see that did not happen. Matter of fact, this high that we'd set last year, just below 850, we didn't break until, like I said, end of September. We got up to 860 and then dropped back down. The pattern continues this year. We're setting new highs, but they are on lower volume. And if you look at divergences in the OSOB oscillator, you'll see that that's also pointing down. So my prediction, I don't really have one, but I'm going to say that if we manage to break this 900 level, on the Russell, we will continue, and this is based on a measured move, we will continue up to about 970, up to about that area, right around there. And that's just based at, here I'll show you quickly how you can do this. So you measure a leg up, and then you basically forecast an extension of that leg, similar distance, so about 970. If we don't manage to break 900 with conviction, meaning, maybe we pop up over it, then, I'll be repetitive. I think the possibility is strong that we're going to drop down back around this 600 level, just because of the divergences and the way that volume has been behaving. On crude oil, let's look at the chart for that. I honestly expected a breakout, and this was last year. Consolidation the whole year, the last 2 years really. Big consolidations. Same pattern with the volumes. The drops in price were accompanied by increasing volume levels, and I thought for sure we were going to break either above or below this box. However, that didn't happen. Instead, you can see January was right there, end of January, right here. You can see instead what happened was the consolidation continued and it got even tighter. And here we have one of these declining triangle formations. Volume, however, even on the new lows, has been decreasing, and it's also been decreasing on the up months. So very tight coil on this spring. It's going to break one way or the other. I think the odds favor a break to the downside. If that happens, I don't think it'll be a huge move. And let me actually move to this chart where I can show you a bigger picture. So the blue arrow is where we were. And if you look back in time, this goes back about 10 years, you'll see that we have this level at about 70, 75, which has held a couple of times in the past. I think this is a very strong level. I suspect we may drop down to about the 70 level and then continue a consolidation. Of course, if we do break to the upside, which is a possibility, my crystal ball is pretty cloudy. The most likely region where we'll start consolidating again is right under about 140. So either down to 70 or up to about the 140 level on crude oil. That's my prediction there. And okay, that's what I said right here on this slide. All of the indices are actually nearing resistance, and the only exception to that is the NASDAQ. So a quick picture here. Again, I'll squish this up. This is the Dow. The Dow just broke a multi-year high recently at 13,300 roughly. You'll see the same thing happening on the S&P. The S&P actually has not managed to break this most recent swing, but it looks like it may be running out of steam with negative divergences. The exception to all of these is the NASDAQ, and the NASDAQ has, convincingly broken this resistance level from a few years ago. So who knows what will happen there. So those are my predictions. What I'm going to do is I'm going to continue day trading following my minimalist approach. I want to explore some new markets. I've been stuck in crude, the Russell, and wheat for years now. I've been following heating oil, and it's just incredible. I do want to look at others, other metals, perhaps not gold and silver, but maybe copper. And who knows, what the heck. Pork bellies work for Eddie Murphy, so they may work for me too. And then finally, what I'm going to do this year is watch what I eat, less of the deep-fried Twinkies and more vegetables. So that's it, Mark. Let me hand it over to you. How do I do that?
Great. No, don't worry. I got it, Will.
Okay.
Appreciate that. So let me go and hand it off to Brian. And all yours, Brian.
Okay. Thanks, Mark. And, well, I don't think you're going to have to worry about the Twinkies because if I remember correctly, I think Twinkies are gone. So I think that is not an option anymore.
Made it easy for me.
Yeah, exactly. All right, let me adjust the recording 1 second. Okay, I'm going to go ahead and talk a little bit about some predictions I have on gold and silver. For those that know me, for those that don't, I've been a big fan of gold and silver physical trading over the last 15 years, and I've had opportunity personally to invest in some pretty big positions in silver and gold throughout the years. And I'll be honest, through that time period, I haven't always been the best at exiting. I've been profitable on every trade, but sometimes I could have held in there for a much bigger profit. And so I'm going to talk a little bit about that in a moment. So let me first cover my predictions from last year and where gold and silver ended up this year. So first of all, gold futures started 2012 at 1586. And actually that should be 2012 right there. It ended 2012 at 1655. That's a 4% increase on the year. So that continues a long winning streak for gold, the 12th year in a row that it's had a positive outcome. Although when we look at the chart here in a moment, you're going to see we're in a consolidation phase at this point. Really nothing that exciting going on. Pretty much sideways movement for the year. My prediction on the year for 2012 was that gold would end at 1900. Well, you can see they're not even close. Unlike Mark's predictions that were a tick away from, his prediction, I'm way, way off there. So, anyways, that is what it is, right? It's a prediction. We have no way of really knowing if that's going to come to pass. So here's my silver update for the year. And actually, that needs to be 2012 there also. Started at 28.33 in 2012 and ended the year at 29.97. That's a 5.8% increase. So last year there was about a 11% decrease in silver. So we've got a little bit of an increase. But again, you're going to notice when I go to the chart here in just a moment that silver is also in a consolidation mode. Not a lot going on right now with these two metals. I think a lot of that has to do with the overall economic climate, both here in the States and the Eurozone. Things have settled down a little bit. We're coming, quote unquote, out of the Great Recession. Things are getting better, not at a very increased pace. It's a kind of a low pace, but it's not as dire as it was back in the 2007-2008 timeframe. My prediction on silver for 2012 was 45. It would end the year 45. You can see that not even close there, so kind of way off. Some things to note on gold and silver for the year. One of the things I noted last year in my prediction presentation was that we need to be watching for QE3, right? And that's quantitative easing. That's where the Fed buys back bonds and they pump money into our monetary system. And basically the idea there is it devalues the dollar. That is typically good for gold and silver. It pushes the value of those two metals higher. But this round, the third round, has been a big fizzle. Really didn't do much for gold and silver like it did in the past QE1 and QE2. I'm going to show you a chart here of QE2, and this goes back to 2010, and this area right here is where we started to get hints that QE2 was coming, And that caused, gold to, this is actually silver to head pretty high, and gold pretty much mirrors this. And then we get, the announcement of QE2. You can see there the very fast acceleration of price action to the upside. Well, let's go to the chart here and look at this round, QE3, and really it was a big yawn. Here, right in this time frame right here, this is QE3 was announced in September, and pretty much there was a little bit of a price move to the upside here in anticipation of it, and then after that, nothing. I mean, the big yawn, the big fade back. You'll notice here too that we are in, this line here represents the start of the year, pretty much in a consolidation zone. Price action not doing much at all compared to prior years. We go back to 2009 where we have that nice steady trend. So as traders, what we know is that markets trend and they consolidate. And out of a trend comes consolidation, and out of consolidation comes a new trend. At this point, we have no idea if the market's going to head higher, break our previous swing highs, or if this is a turning point, we're going to get a double top and then a move to the downside. We just don't know that at this point. Let me go back to my presentation. And so that's pretty much the update on gold and silver. As far as my prediction for the year, again, this prediction, I'm going to predict that gold's going to test 1944. That was the high. And then pull back at the end of the year and settle around 1800. And on silver, I'm going to predict that we'll test the swing high at 45. The all-time recent high was 50. And so I'm going to predict that we'll test that swing high at 45 and then settle back and end the year around 39. So we'll see. Who knows? These are predictions. The one thing that I want to point out is rather than predicting, I want to encourage you to use an approach to your trading. And so I want to spend the next few minutes here talking about that concept. And recently I had the opportunity of turning 50. And I've taken a lot of ribbing, both inside of NetPicks and personally from friends, at reaching that milestone. But the one thing that's kind of hit me almost in the face with this event is that retirement is soon, coming. It's coming in the next few years. And for me, that means I need to focus on my retirement planning, both what I have saved to this point and what I want to save going into the coming years. And that is what I call longer-term trading. I think each one of us are in that mode at some point. Some of the younger people, obviously, if you're in your 20s, retirement seems like a long way off. But those in my age category or even older, it's something we focus on. And what I want to encourage you to do is to really let price action tell you what to do. I'm going to go to the chart here in a minute on the Dow, and I'm going to show you the price action from the last few years. And rather than a lot of the people that I've talked to in their 401k accounts, rather than being a buy and hope trader or buy and hold trader, hoping that the market's going to head higher, I want to encourage you to actually take action inside your 401k and trade it based on an approach or a method that tells you when to go long and when to go short. Now, maybe in your 401k you cannot go short. That's fine. But you can definitely go flat. And that's almost, in some cases, as beneficial as going short, being out of a downward market. So what I want to do is go to the Dow chart here and just take a quick peek at the price action on a weekly chart here over the last few years. So this line right here represents the beginning of the Great Recession, or that's what the pundits want to term it. It could have been termed a depression too. I think this was used to kind of filter out what it really was, but it was a significant downturn in our economy. Who knew at this point in time that the Dow was going to head lower by over 60%? That's a pretty significant move. Okay, and what we're looking at now is just a weekly chart without any kind of indication on it what to do. I mean, obviously we know the result here. We know that it went down 60% and it's now recovered back to that same level, the highs that we had back in 2007. So again, what I want to encourage you to do is engage in an approach that tells you that you should either be going short the market or long the market in a long term, rather than simply, being long at this point, hanging on through this kind of a cycle down, and a move back higher. And I've actually got some stories, individuals that I've talked to where, we get these moves down. I know a lot of individuals that rode this move to the downside, 60% down on their accounts, and bailed roughly in this area right here, and they've been out of the market since. They haven't gotten back in because, maybe it's gonna go back down again. So they missed out on this entire move up. So not only did they take the loss, they didn't benefit on the upside. What if you had an approach that told you when to get in and get out? All I'm going to do here now is turn on one of our calculators that we have at PTU. And this really could be any approach. It could be SST, it could be Trend Jumper, it could be an approach that you have, just something that tells you you need to be short along the market. Look, in this case here, in 2007, back when the Great Recession began, this approach right here said we should be short the market, right? And so if it's your 401k and you can't go short, there's plenty of ETFs that you can go short, by the way, may be available inside your 401k. But if you can't, then you go flat. And the next time we get an indication to go long isn't until almost 2 years later, in August of 2009, that we get our long. That's well off the bottom here, right? But at this point, we go long, and it's pretty much been that way the entire, 2+ years here since that point in time. So anyways, bottom line there is I want to encourage you this is not even swing trading. This is really what I call long-term trading, long-term capital preservation of whatever you might be trading, whether it's your 401k. You don't have to come in and look at this every day. This is a once a week, once a month type of thing, and see what's going on. And make those trade decisions in your personal account, and hopefully you'll benefit from that in a much bigger way than buy and hold. So that's my little tidbit that I wanted to give you. Bottom line here is we have no way of knowing what the future's going to give us. We're having some fun with predictions here. I want to encourage you to use an approach, a method that tells you when to get into the market and get out. So, Mark, that's my presentation. Go ahead and take it for the next person up, which I think is Mike.
All right, great. Thanks, Brian. Appreciate that. I'm going to make a prediction about Brian for 2013 based upon his slides that he's still going to think it's 2012 in 2013.
Yeah.
But the fact is you did admit to everybody you just turned 50, so I think that actually explains
an age
a
thing.
lot. Yeah. So we do excuse you for that. No problem.
See, the ribbing continues.
All right, Mike, all you.
All right, thanks, guys. Well, like Brian, I too hope to retire here in the next couple of years, and the fact that I'm still in my 20s, the market really needs to cooperate for me over the next couple of years to make that happen. But really what I've seen over the past year or so in my own trading, I've really seen myself transition out of more of a position trader to more of a short-term trader, and I'm going to get into that more here in just a second. But instead of giving you specific price targets like the previous couple of coaches have done, I'm just going to give my prediction on what markets I think are going to be active, because when you really stand back and say, okay, what do I feel the market's going to do overall, I really don't care if it goes up or down. My trade universe really doesn't go out to the end of the year. It doesn't matter to me what the market does. I just want to make sure I'm trading the markets that are moving. Okay, so for me, I'm a day trader as well as a swing trader, so I'm going to start out with the day trade side of things here first. The market that really has me most excited right now is heating oil. Heating oil futures are just phenomenal. I've been trading them now for about 6 or 7 weeks. I've just seen some great success, and the reason I love trading that market, it trades a lot like crude oil used to, where when it breaks out, we actually see follow through, and we actually can see some big trending moves. So it's not uncommon to get out of a heating oil session with 100 ticks, 150 ticks, because when it breaks out, you can see those large runners, and it's really exciting to see that. On some of the other common markets to look at, crude oil, some of the index products, we're still seeing some profits there. It's more difficult. It's more of a slow grind. So to identify some of those hidden gems like heating oil or like wheat futures, I think that's going to be key. So as you go forward into 2013, don't be locked into the same markets that you've always looked at in the past. The index futures, gosh, they're difficult to trade these days. We don't see a lot of follow through. We see a lot of quick bursts in the market, but there's really it can be difficult to trade intraday. So I really like the energy markets. I also like markets like wheats and soybeans. I think those are great areas to look at as well. So moral of the story there, branch out a little bit. Be willing to look at markets that you may have never considered in the past. If you do take a look at heating oil, you do have to be comfortable with the fact that there will be slippage. Okay, the way I have my trading platform set up, I'm willing to give up to 4 ticks of slippage when I get in, because it will happen. Okay, if you're uncomfortable with that, it's not going to be the market for you. But when we're seeing profits of 100, 150 ticks, am I going to be concerned with 4 ticks of slippage? Absolutely not. Does not matter to me. So that's what I'm looking to do on the day trading side of things. On the swing trading side of things, I just personally feel swing trading is just it's a great place to be involved in as a trader. So a lot of people are just attracted to the day trading side of things. They want the excitement, they want the quick profits, and that's great. You know, I'm with you on that one. But there's also that other side that a lot of people miss out on. So swing trading options, when we look at a lot of these day trading markets where we talk about the volumes dropping off, we really haven't seen volumes drop off that much in the options world. So I really like to trade some of the swing positions with some of the active stocks. So I'm just taking a look at a couple of my recent trades. What I've noticed really over the past 6 months or so, it's difficult to see follow through on some of these moves. So what I've done in my own trading, and I'm just going to use a trade on Apple here from yesterday as an example. I actually got into a put position last week on Apple, and it was just chopping around. It was really difficult to make any ground up, move towards some targets. We actually took some heat and approached a stop out, but we came in Monday morning and we gapped to the downside. Okay, so we came in yesterday, it gapped past my target. It was very tempting for me to stay on board this trade and try to capture an even larger move, but what I did is I took advantage of the gap, gapped in my favor, and I got out of the trade yesterday. Okay, I had a 110% return on my options, about $2,700 worth of profit. Now I took advantage of that because of what I've seen in the overall market, where when I can lock in those profits quickly, I'm going to take advantage of that. I'm not going to be greedy. I'm not going to hold on and wait for the big moves, because we just haven't seen that very much really over the past 6 months to a year. So that's what I did. Now I left some profit on the table. Apple's down another, gosh, $15 today, which I did not take part in. But it was just a really nice trade last week, and I want to use that as an example of how you need to be quick to act in these trades, because the market can be very whippy, especially with all the headline risk in the markets these days. I mean, we went from the end of 2012, where everybody's concerned on the fiscal cliff, to now everybody's talking about the debt ceiling. You know, it's going to be one thing after another here as far as the news goes. So you have to be quick to act. When you can lock in profit, you're going to want to do so, because the days of seeing those really extended trends, those extended moves, it's just going to be more difficult to see that going forward. So that's why I like to have systems like the PTU, like Trend Jumper, where we can get in and get out and take advantage of those swings back and forth. I don't care what the market's going to do the rest of the year. I don't care where it's going to be at the end of 2013. I just want to trade the markets that are swinging back and forth. So really what I wanted to do, instead of giving you a prediction for the end of the year, what am I looking at over the next couple of weeks on out through the next couple of months? Well, I'm going to use my market overview charts here, and I'm going to use the spider, symbol SPY, which is an ETF that tracks the S&P 500. Now what we're looking at, 2013 off to a good start, but a lot of this move is in the gap to the upside back on the 2nd of January. All right, so whenever we see a large gap on the chart like this, traders do not like to let these gaps go without at least attempting to fill part of the gap. So can we move higher from these levels? we definitely could, but odds favor at least a pullback to fill part of this gap. I'm not talking about a total market collapse here, but I want to see us pull back into some of these support levels. What that's going to do, number one, it'll give us a chance to play the downside. If we can get a pullback here on some decent volume, we can play the downside. Purchase some put options, short some stock if you prefer to do it that way. Definitely think there's some ways to play that move to the downside. If we don't get any short setups on that move, if we can get a pullback into these support levels, it'll at least give us a better place to enter into some new long trades. Okay, I don't have a problem getting long at these areas. It's just, I think it's a riskier place to get long. So I'd like to see us get a pullback, be able to get in at some better price points. Okay, so ultimately I do think we should move higher in 2013. I don't have a specific price target, but I want to see, short term, I want to see a pullback into test some of these support levels. And we'll see, maybe earnings season, which really kicks into high gear next week, hopefully that'll allow us to at least get some movement, at least to allow us to break out of these tight, choppy markets that we've been stuck in over the past week or so. Names that I'm going to look at for 2013, I just listed 5 here on the screen. These are not best 5 by any means. These are just 5 names that I've seen really consistent results with over the past number of months. Obviously Apple, I mean, we all know how active Apple has been over the past couple of years. I don't see that changing anytime soon. SPY, again, ETF tracking the S&P 500. XLE, which is an energy ETF. Amazon, obviously pretty active name there as well. And then Visa. I think this is a great starting point. If you're looking for some names to track on a swing trading basis with some options, at least for the first half of 2013, I think this is a great place to start tracking. Okay, so I know I didn't give you any specific price targets, but hopefully I gave you some new names to look at, so some food for thought there as we head into the next couple of months. So with that, Mark, I will go ahead and pass it back to you.
Great. Thanks very much, Mike. Do appreciate that. So let's go ahead and move it along, and we're going to go hand it off to Ron next. So Ron, you should have the projector.
Welcome, everybody. Anyways, that's will you be Superman this year and make it your year? So 2013, I think, will be the year of Premier Trading University. People will gravitate over to the full all-encompassing education and training and live room, and really improve their trading. So we'll take a look at my 2013 predictions, but first we'll review my 2012 predictions, and maybe I don't make any crazy predictions, so mine have been correct the last 2 years, so we're doing pretty good, and I'll go to the charts in a minute and show you. I do believe in 2013 the government will do its usual thing, and we will then get downgraded by Moody's. So we did at S&P do it a couple of years ago, and so that's going to be a big factor in my predictions. So what will happen? Gold will break 1800, and if oil breaks 95.50, because it's been kind of in a range, just hanging out, look for it to go up to 100. So we'll take a look at the charts, and I'll kind of show you what makes me think these things. So this was my 2012 predictions. I said oil will break 110 and maybe up to 115. Well, I missed, I got my 110. It was quite easy. The last year's meeting was right about in this zone of January, and I missed it probably by about 30 cents to the 115, so not bad. I also said there will be some very nice trends, and that's a generic prediction, isn't it? I mean, who can't go wrong with that? But anyway, you can see with this chart of oil, incredible trend to the downside, and you probably would have gotten out somewhere around that 85 level with the consolidation. It did break lower again, and then we got a really nice uptrend, several waves. So looking to more recent history in the fall, obviously we came down from our high of about 102 and went down to that $85 level. That's a pretty big level to 85. So if you take a look at the fibs, Right now, we are at that 50% retracement, and so the 60% where pretty much it will then reverse, and look to go long is that 95.50. So again, if it breaks 95.50, I think it will head on back up to the the $100 level easy, and maybe back up to the 102. So that's my prediction on oil. And let's take a look at this thing too. Let me click it. Let's go to next, I guess. Does not want to change the slide. There it goes. Okay. So my prediction on gold. What will happen in 2013? I do like to trade the gold and oil. This was the close in 2011 and around 1582, and you can see actually there was one other slide that didn't come. Let me go back to this slide, and this is what bases my prediction on. Does anybody remember what happened in August 5th of 2011? That was when the S&P downgraded the U.S. debt. It lost our AAA. So, and what did gold do? Shot up. This red dashed line is that $1,800 level. Obviously, it spiked up big time, but has come back, and it didn't do much there for 2011. So then let me fast forward to this year, and this is what we're looking at now. This year, we have this double top, and really going back into 2011, there's really kind of a third top there. So I believe it will break that $1,800 level. That 1802 is a very, very strong position. So taking a look at the fibs, the high to the low, we've got a ways to go to get up to this 50% retracement. So, you don't need to get, I would be, accumulating down here, at the 1650, anything below 1700, and, look for it to break higher. So that's my prediction. So I was going to keep it short and sweet, and we'll find out in a year how I do. So thank you all, and I'll turn it back over to Mark.
Great, thanks, Ron. Good job on the prediction on crude there as well. So let me go ahead and switch it over to Bob. I think, Bob, you're up next, so you now have the presenter.
Okay. Am I coming through okay right now?
Yeah, I see your PowerPoint.
Okay, does that look good?
Yep, looks good.
Okay, I'm going to keep mine short and sweet too. We're approaching the hour mark here. Here's my basic summary of 2012. We basically had a little bit lower volatility in the market than the previous year, with lots of great swing trade opportunities and some nice trends setting up in a number of markets. The magnitude of the reversals this past year was not as great as the previous year, and I'll show you a chart coming up. And we had great, good day trading opportunities. Now, there were some levels of uncertainty that decreased over the previous year. As we know, this past year was an election year. We had issues in the Eurozone that caused large market swings. National debt hit $16 trillion last year. Housing prices went up about 5%, and GDP started to pick up a little bit, still a little weak at 2%. And again, showing the greatest level of uncertainty easing was the VIX. And if you follow the VIX, which is a volatility index on the S&P 500, last year it was pretty low. And in fact, last week it hit 13.22, which is very low. It's the lowest it's been since June of 2007. So overall, the market level of volatility was decreasing, and some of the levels of uncertainty were falling, and even though we've had these major issues to deal with. This was a chart that I presented last year showing what happened for the previous year from last year, which would have been 2011. We had a number of reversals throughout the year, a much more volatile market, and there were 16 reversals in 2011 that were greater than 7%. But the market net for the year was almost exactly 0.00%. It didn't go anywhere for the whole year, even though we had all these incredible swings, and again, 16 reversals greater than 7%. 2012, last year, we saw only 4 reversals that were greater than 7%. A much more of a basic trending market, and as Mark and Brian noted earlier, the market was up, depending what index you're looking at, 12 or 13%. But again, this past year, a great market for more swing trading, for taking advantage of some of the longer-term trends, fewer number of reversals, and an overall net of about 13% for the year. Since the beginning of 2013, we've seen the market just go up a little bit. As Will has shown, we're kind of bumping up against some support level. Today it hasn't moved a whole lot, but again, just a few percentage increase for this year, mostly due to a gap up at the beginning of the year, but basically bumping up against a level of support from last year. I'm sorry, a level of resistance from last year. Okay, my outlook for 2012. This was my market slide that I presented last year. Last year I said we're going to see more of the same this year. We're going to see volatile markets with big swings. There'll be uncertainty in the market because it was election year. The Eurozone, the debt crisis had not been resolved. Unrest in the Middle East. National debt has not been addressed. I thought that housing sales would be up, due mostly to investors, but that prices would come down. GDP would remain fairly flat, and my outlook for the year that just passed was that stocks would be down in the near term and then up in the long term, and bonds would be down in the long term. Well, here's my market outlook for 2013, and I simply took the previous slide and just modified a few things. I'm still saying there's going to be more of the same. I think we're still in kind of a volatile market with some big swings. As far as uncertainty goes, well, it's no longer an election year, so that one's out the door. But the rest of them don't really change. Eurozone, there's still a debt crisis that has not been resolved. We still have unrest in the Middle East. National debt, last year I said it would not be addressed. It wasn't addressed. It looks like it's not being addressed this year as well, and that's an issue with uncertainty in the markets. Housing sales, I think, will continue to be up. But not only with investors now, there are more young people entering the market where they're seeing good deals and some good foreclosure prices, that are bringing more people into the market. So instead of prices going down, prices I think are starting to go up. And this is where my prediction last year was incorrect. Prices did not go down. In fact, they went up about 5%. GDP still about flat, maybe 2-3%, somewhere in that range of growth. Outlook for 2013, last year I said stocks would be down in the near term and then up in the long term. I think they're just going to be kind of up in the long term. I think some of those resistance levels that Will's pointed out and others have pointed out, I think they will be broken. I think long term, I think the stock market will go up. And one reason for this is the next bullet, which I think is an important bullet, which a lot of investors are tending to overlook these days, and that is the bond market. The bond market is a huge market. Last year I predicted the bonds would go down. They were pretty much flat the whole year, and that was due to the Fed's quantitative easing attempts. And as Brian pointed out, with each successive quantitative easing provided by the Federal Reserve Board, there's been a decreasing impact. I think they're totally running out of steam with the quantitative easing. I think it will continue to have not only a decreasing effect, but possibly no effect. And since that quantitative easing is holding up the bond market, I do believe the bond market will start to head down. And when that happens, investor cash will tend to flow into the stock market. Investors looking for a place to put their money. So my plan, basically, my plan is not to look at my predictions. I don't rely on long-term trends or long-term plans or predictions. Continue with swing trading. Continue to limit picking the direction, to the most confident trades. I like to use options to supplement with some premium selling when possible. Day trading, I'm sticking with the most liquid stock futures and Forex markets, and I'm limiting to the markets and limit the number of markets and time frames I do trade, And I like Will's approach of the minimalist trader, where I tend to not try to day trade all day long, but pick key markets and time frames, generally earlier in the morning, and go that way. So basically, my plan is not changing from the previous year. This is the same plan that you saw last year when I made my market predictions. That's all I have to say, Mark. I can turn the controls back over to you.
Great. Thanks so much, Bob. Do appreciate that. So let me hand it off next to Shane. So Shane, you're up.
Okay. How's that looking? Looks good?
Yep. I see your charts now.
Okay, good. First thing I'm going to say is, my predictions, I don't want to predict anything, but only thing I will say is we're going to have what we have every single year is we're going to oscillate between a risk on and risk off environment. And when that occurs, you're going to have to trade according to that. My only concern is because I am in Canada, I do have an American bank account. And unfortunately, over the last little while, it's taken quite a beating as the U.S. dollar got weaker and the Canadian dollar got stronger. And so the only thing I can predict is I think that's just going to keep on continuing for me, especially when Canada is now talking about raising interest rates. And in the Forex market and the currencies, that's where people buy into. They buy into the Canadian dollar using U.S. dollars, and then you get that interest rate differential. We saw it a lot with the yen. It's called carry trades. So I think the Canadian dollar is still going to get stronger, at least stay around par. I don't see myself making 30% on my money like I used to, but that's that. So what I'm going to do here is, Mark had said that he predicts about 70% people getting back into swing trading. And for me, I started in my career as a day trading Forex. And I found with spread costs, et cetera, it just, for me, it just became, the cost of doing business was quite large. When you're trading, smaller amounts, it's not that big of a deal, but as you get bigger and you trade a bit more size, you start losing more money to the broker. So I started going off into more of a swing trading aspect about 2 or 3 years ago, and over the years just continued to grow and grow and grow. And so now mostly 99% of my trading when it comes to Forex is the swing trading. And what I like to do, when you look at my chart right here, looking at some yellow or green, yeah, that's green, green boxes, green lines, and you're seeing black lines. I trade more of a longer-term approach, looking at the weekly and daily charts. And all I'm doing here, and I'm going to give you a few more charts here to take a look at and some areas that I've got marked off, is I look for areas where price has exploded from. Because when price explodes, what we're looking at when price explodes is that's not the retail traders. That's the institutionals that are buying or selling. Okay, so to me, those are the areas on a chart that I zone in on. Now, people talk about support and resistance, right? People will put like a line up here as a possible resistance level, but that's not. You want to quantify it a lot better, and that's what I've been doing for quite a while now. Is I just zero in on places where price exploded from. I go to a weekly, I go to a daily, and sometimes, very rarely, I go to a 4-hour chart. And what happens for me is when price reaches those areas, especially up here, these weekly areas are beautiful, is I'll go down to a lower time frame, like an hour chart, and I'll start watching price action. And it could be as simple as drawing a down trend line, for example, as I expect something to break up, and look for a break of that. And the great thing about that, and I'll continue to do this, so I predict that I'll continue to look for very small risk, large rewards, where I can get into a trade, 30, 40 pips maximum in risk, and shoot for the 5, 6, 7, 800 pip moves. And near the end of this, you're going to see a euro yen trade that I'm in right now. That's what I'm shooting for. So looking at this chart here, this is the NZD USD chart. These black lines are weekly areas where price has exploded from, like you see on these things right here. So when price returns to these areas, I expect a reaction. What the reaction is, I don't know. So I zoom in, and Brian had said to watch price action for longer term trades. Same thing. I'm going to look for the price action, and if it's showing, it's going to show me my direction. Okay, so the area that we hit now, 84.71, it's right into this area, this weekly area. The areas are huge. Okay, so you're not just going to trade off of those areas. You're going to smaller areas to trade from, and you can see that these are like magnets. Price explodes from here, price comes down, leaves the area. It happens all the time, and this is how I've traded for quite a while, just pure price. I do use a few things, but I don't trade it using indicators. It's just to kind of give me a guide, like a framework. You're looking at these these kind of price movements, sometimes it can be kind of tricky. So this is NZD, USD. These are the areas that I've marked off for so far this year that I will look to take action on. We're already up on these areas. And you're not going to get all these trades. It's just not going to happen. You got to look at your overall market exposure, which I always do, and risk per trade. Okay, so take a quick look at this. This is the areas that I'm looking at. So let's go to the next chart. Can you still see that? Okay, good.
Yep.
This is the Euro US dollar chart. Once again, you know, it's Euro US dollar is not my favorite to trade, simply because it's such a heavily traded currency pair that you get these levels where bouncing all over the place because it's just there's so much attention paid to it. So I've marked off a few areas that I like. These black areas, you know, whether we're going to get there or not, I don't know, but they're there just in case. And you can see, you know, these aren't cherry picked. These charts I went through like I always do with a magnifying glass, but I want to see these moves move with some strength, and almost without fail. When market returns to these areas, there's reactions. Like I said, you're not going to get all of them. So this is Euro US dollar. Like I said, it's not my favorite pair to trade. You know, I'm expecting a 41.92, some reaction up in this area here. We've already reaction in this area. Pretty close reaction in this area, and up here I'm expecting some more. Whether I'll trade them or not, probably not. Euro US dollar is not my favorite pair. The pound US, I got two charts here. This is a weekly chart. Pound US last year for me, as was the Aussie US dollar, were very, very good. And these red lines are simply areas that have gotten beaten up over the last little while, and I'm going to be a little bit more careful taking trades in these areas. But you're looking in these moves here. I think it was over 1,200 pips in total, just trading these little moves here throughout the course of the year. Once again, we've got these lines up here, and this axis is a great example. Here's a weekly chart, and you can see these big moves out of here. And I just marked off that level. When price comes back, I'll look to do something. What it's going to be at that time, I don't know. It's going to depend on trend direction. Well, it's not, we're on weekly now anyways, but it's going to depend on trend direction and what the price is doing at that level. And let price tell me what to do. I'm not going to forecast it. Same down here around the 4,400 level. I want to see some action down here. We've been ranging quite a bit. And you can see we're ranging right below this weekly level here. Just remember, when we're looking at these levels here, whatever way you're mapping out support and resistance, if you can see it, other people can see it. And there's always order blocks in those areas. So don't always look to trade right to the the pip. It's just not going to happen. This is the weekly chart. Like I said, you can see where the reactions have been there. Here's a daily chart. And once again, we've come into this weekly area, and its prices dropped from it. It was 63.49, 63.50, and it dropped, over 300 pips. Not bad. Once again, this is you can see these strong moves up as a price came up, consolidation, and then it just basically flew. Price came back down to the area. We had a reaction off of that. So I'll look to take trades in those areas. So I'm not always looking at the chart. I'm not here spending, 8 hours a day looking at the chart. I come in, I look around, see what's there, and if something's there, great. If not, I won't bother with it. U.S. dollar CAD. Oh, my nemesis. Yes. Once again, I've mapped off some areas that if it was to get there, I'd look to take action at. And you can see here it's the dollar 1.0169 area to the 1.022. I'll look to take action in this area if something shows up. Same thing here. This is off a daily chart. Big moves up, right? And this is all I'm looking for, these moves. And once again, when price came into this weekly area, look what's happened. Every time it's come down here, this actually goes further to the left. Action, action, action. Right? So you just want to take action in those areas if something sets up for you. Aussie US, that was so great for the longest time. With the Aussie dollar was so strong against the US dollar. And I was talking to Mark last year, and we talked about this, and I said it was just an amazing pair to trade at times. And once again, you can see what's happening. Where the price just rockets away, price comes back up, goes away. Right? This is not a mistake, right? This doesn't happen by accident. You're looking at where institutional traders have taken positions. So the areas I'm looking at here, if it ever gets up here, 1.0969, down here at 1.0162, This area has already been kind of beaten up, but you can see where prices kind of gravitate at these levels over and over again. If I was to draw this over, you'll see where these reactions have happened. This is off a weekly chart, so it looks huge. You're probably looking at that's a huge area, but it's off a weekly chart. So when I can get a weekly and a daily like this, even better, even better. Once again, here's off of a daily chart, the big move up, price comes back down, splashed around a little bit, flew back up. Like I said, you're not just going to jump into a trade. You're going to gear down to smaller time frames and see what price is telling you. And then, you get a low risk entry that way. And down here at 0.9529. And yen crosses are a little bit tricky simply because the Japanese government loves to throw these interventions at you at like 7 o'clock at night. And so sometimes when you're looking at the chart, it's like you don't know if the move was institutional or was it the government. And you'll find a lot of times they'll intervene. It'll last a little bit, and then it'll just come back to what it was doing. So it's very, very tricky to trade. This is actually breaking out of a weekly level. As price came in here, nothing was happening, and price was breaking out, and it was in this area here what the long went. Stop target. I'm looking for 900 pips on here, and right now, if I get stopped out, it's going to be 273. But it was like, I think it was 47 pips or 37 pip risk on this. So the position sizing was what matters. Never amount how many pips you get. Okay, as I know, a lot of people hear forex trading. Don't be when people say, "Yeah, I made 1,000 pips on a trade." It's absolutely meaningless if they're trading, 10 cents. Right? You don't need to go for the big, huge home runs if you're trading some size. Just keep your risk down. You can see right here, big move out. Right? Price comes down. It broke right through, but look where it comes back up to. It tests it. This was a short actually last year off this level here, 101.72 level. And I had one more. It was no, we're back to the beginning. And that's it. So my predictions, like I said, risk on, risk off environments are always going to happen. I'm going to continue to look for the higher time frame position trades. Well, it's not really position. I like them to be positions. My biggest one was a 1,027 one a few years ago. But recently, with all the stuff that that's happened with the economies, and it's been harder to get those moves just flying. Right, they're always running into something. So risk on, risk off, and that's it. Stick to my day trading and day trading some other stuff, and swing trading my currencies. Thanks.
Great, thanks, Shane. Good stuff as always. So let me hand it off to TJ, and there you go, Troy.
All right, thank you. Wow, really great stuff. Giving me some ideas. All the coaches really appreciate all these great minds and insights all together here today with some great ideas. I'm sure there's a lot of people in our audience too with some great predictions. I'd love to hear what some of those are. I don't know if there's a place on the owners clubs or any of the blogs where some of you can post some of those, but I'd be curious to hear what they are. I'm not big on predictions myself. Mainly because as a day trader, and I know this, the other coaches have said this too, but as a day trader, I mean, I'm just looking to put the odds in my favor, and I'm either going to go long or short depending on what's right in front of me immediately, and I'm looking to, the quick hit and then get out of the way. Even my swing trading is pretty short term. But with that being said, it is fun to try to predict, and I do think there's some insights to be had. I agree with pretty much what most of the coaches are saying here. Will stole a little bit of my thunder, so I'm going to expand on that, and I totally agree with his thoughts on where the stock market's headed. And Bob said something that was very interesting to me too that I just decided to point out in a second. But let me just talk a little bit about last year's predictions. I didn't really make many. I mean, I said that the Russell was going to be troublesome until the spring, and then it was going to break out and give us some great trade opportunities, and that's pretty much what happened again this year. Or this last year, if you'll remember, it was pretty problematic up until mid-April, and then of course it exploded again, and it wasn't really that hard of a prediction to make because that just seems to be the continuing pattern. And I suppose a low-risk prediction would probably be to say it's going to do that again this year. So I'll stick to that and just say that pattern will repeat. And then I made a fun prediction that the U.S. dollar was going to go down against the Mexican peso. And I just want to kind of show you this is where it was when I made the prediction, and this is what happened. Shortly after about 2 months, it had dropped all the way down to its 50 EMA pretty much, and then it sprang all the way back up again, and a chance to actually get short again. And here we are, and I think that if, I mean, this is pretty obvious charting technique, but if it could break below the 50 EMA, the dollar will continue to weaken against the peso. So a currency pair that is probably overlooked by most, but this is one I've enjoyed trading this past year, of course on a shorter time frame. Okay, so maybe an unconventional prediction, but I think the peso will continue to strengthen against the dollar. Okay, speaking of the dollar, and I'm going to keep this short because I realize that we're kind of bumping up against our time limit here. I think you can get a lot of insight on what's going to happen next with the U.S. market, and of course everything's attached to the U.S. market. So if you could interpret what's going on with the dollar, you can really get some big-time clues. And it seems to me, dating back about 10 years now, that the dollar is trying to put in a bottom. It's starting to round out. It put in a low back here a couple years back. Maybe it's going to come down and test it. It looks like it is. There's a trend jumper set up on the monthly chart. Hasn't hit the entry yet, but it's showing that we could come down and retest. Do you really think that it's going to break lower? I guess it could. There's a lot of motivation for the dollar to go lower. I started listing some of the typical forces against the dollar here, and obviously the Fed has a motive to keep the dollar low, right, because of the national debt, to increase U.S. exports and help the economy and this and that. And there's a lot of other things that can keep the dollar low. But then, there's some forces to try to strengthen it too. The rest of the world, they want low currencies as well, obviously, because low currencies is good for exports and good for their debt. So, where's the dollar going to go? I suspect that it's probably going to try to test these lows and hold, and it'll just kind of skid along the bottom and start to round its way up. But this is going to take a long time. I don't think it's going to happen anytime soon. And one thing that struck me when Bob was talking about reversals in the markets, I found this very interesting. And he was saying how in 2011, and correct me if I'm wrong, Bob, but in 2011 there were more reversals of 7% or greater than in 2012, which tended to trend more. And so I started looking at the dollar, and if you notice that when the dollar has a peak and then heads lower, I mean, you could pick this off pretty close to the month, but I mean, this happened right around March and April of 2009, right? And if you flip over to any old S&P monthly chart, I mean, look at where the rally started. This was right at March and April of 2009. So the weaker dollar is what's pushing, or what I think is a big catalyst to rising prices in the stock market. And then you can see it again on these other legs up on the S&P. If you jump back over to the dollar chart again, you could see where the dollar comes down and the dollar comes down, and even so in 2012, where you had less reversals and more of a rally and trending moves to the upside, you could see that the dollar weakened. And of course the range was tighter on the dollar, and the range was a lot tighter in the U.S. stock market as well. So interesting correlations there. I think my simplistic way of looking at things, I don't try to overthink stuff, but it just seems so obvious, because when the dollar is weaker, you need more of them to buy any old thingamajigger, right? Whether it's this widget or that thing or whatever it is, if you're using dollars to buy it and all of a sudden the dollar is worth less, you need more of them to buy the thing. And so the price of that thing is going to go up. And in this case, commodities, the price of stocks, they got to go up because it takes more dollars to buy them. And when you get the weaker dollar, that's what happens. So, but the interesting thing is the dollar weakening or not? I suspect in the next short term, it probably will try to test this low, but if this is a true long-term bottom coming into play here at some point, the dollar could pop. Okay, who knows when that'll be. So that leads me to at least some of my 2013 predictions. And again, I just say this mostly tongue-in-cheek, although maybe the first one I do think will happen. I do think the markets are going to rally, and they're probably going to rally on lower volume. In fact, before I show you the rest of this, I just want to point out a couple things, and this goes back to what Will was showing you. The Russell is breaking out to multi-year historic highs, and that's just happening like right now, this month. So multi-year highs, okay? And if you look at the NASDAQ, for example, the Qs, its highs are way up here, and they're just way out of whack due to the dot-com boom, right? And then the bust. But it is breaking out to multi-year highs. I mean, it's really moving, and between the two, the NASDAQ and the Russell, that's leading the charge, and then you've got the S&P and the Dow trying to play catch-up. So go back to the S&P, and you can see that I put lines here to mark the significant highs, and it's trying to catch up, and we're going to have to watch and see if the S&P is going to be able to get through all this resistance. But I predict that if it can get through the 1700 level, that's going to start to bring back the retail trader investor, the mom and pop investor, and we're going to have to be on our toes, because we're going to see at some point, if that does happen, a blowout on volume, and that's when we're going to want to get short. Okay? But if that also happens, it could drive the market up for quite some time. And you could see also on the Dow, same type of thing. It's getting close to the multi-year highs, but it's behind the Russell and the NQ. The other thing I wanted to point out, and you could probably see it better on the S&P, is that look at the volume that this rally is happening on. I mean, it's low volume, right? But let me just go to the S&P because you can really see it better. If you look at, oops, it's under here. If you look at the Spider, for example, when it was making these big moves to these historic highs, even the second time up, all before the financial crisis that occurred, and I joined NetPicks right in this area in 2008. All this volume happening, but when it was going up, look how low the volume was then, okay? The volume is low now compared to what happened over the last 2 years, but it's still higher than when it was back here, and even much higher than when it was even further to the left, right? Just a lot more access to the markets, I think. So it's I think volume is going to go up and up and up eventually if it can break these levels, because that's what's going to, I think, bring more participation back into the market. So watch the U.S. dollar. If the dollar keeps getting weaker, I think that's going to help drive that. All right, so anyway, that's kind of my way of looking at stuff. I do think, and Mike Rixey talks about this a lot because I know it affects his options trades, but I think this is a big deal. Headline risk is going to continue to present buying opportunities because it's going to cause panic. The markets will drop in a panic, and I think the fundamentals though are still in place. That's when you're going to want to jump in and buy stuff cheap, because I do think that those are buying opportunities. And I do also think that the best trade opportunities are going to be in the less commonly traded markets. Mark pointed out energies. I totally agree with that. Heating oil, obviously. You could see what it's doing along with some others, but I also think some other markets too, the agricultures, you can't overlook those, okay? And then I think the Niners are going to win the Super Bowl, so we'll have fun seeing what happens over the next few weeks. That's obviously my team. I think the Giants are going to put together another winning World Series. I mean, why not? It's my prediction, wishful thinking. Last year I wish oil would drop $60 a barrel. I used to talk about it in the trade room all the time. Didn't quite drop $60 a barrel, but I think it dropped like $35 a barrel. So I could wish for the Giants to win another World Series, and then I think Venezuela will reclaim its gold medal in its only Olympics event, Miss Universe. They came in third in 2012. I think she's going to be the Miss Universe in 2013. Those are my predictions. Back to you, Mark.
Thank you, TJ. I didn't know that there was a Miss Universe futures market that we could get involved in.
Well, I mean, you could trade the Venezuelan, what's that currency called? I should know it.
I have no
Lost
idea.
so much money in it over the years.
All right, so appreciate that. Thanks to all the coaches.